So around 4 months ago, I did a video on MPW stock. I reviewed the company. I said it's pretty much a disaster. I said people to stay away from it. I said it's not worth the risk reward. And I did say that the dividend cut is pretty much imminent. Well, if 4 months later, MPW is still making a new low, they did cut the dividend by over 48%. Pretty good news, but I still believe this dividend cut is not enough. I still believe the company has a lot of problems, but things are starting to look much, much better for MPW. I think a lot of the bad is priced in within the company, so I'm going to review it in this video, review the dividend's health after the 50% dividend cut, review the debt structure and the debt repayment, and just give you my opinion in general and let you know if I believe MPW is a great buying opportunity at such prices or if it's maybe still a trap after the 50% dividend cut. Now, most of you are familiar with MPW. They own those kind of medical properties, hospitals, a lot of other kind of, in the medical field, over 444 properties in over 10 countries. It's a pretty well-known company. And if you look at, their biggest risk, and this is well-known, most of you are familiar with it, they had a lot of problems with the tenants, like Steward Health. They kind of defaulted on some of the leases before, and then they had to do some restructuring and try to pay some of them back. And now MPW is trying to lease something to Prospect, some kind of investment into Prospect, and forgive them on the leases. So a lot of their operators are in trouble, and they have very high concentration risk, where, for example, Steward Health makes over 19% of their assets. So they have a lot of concentration within those tenants, and those tenants are not doing well at all. Now, if we look at the cash from operation, and this is why I still believe the 50% dividend cut is not enough. And I personally believe there will most likely be another dividend cut in the future. This is just my opinion. I'm going to tell you why. If you look at the cash from operations, it has been deteriorating from 213 to 181 to 135 to now 76. I mean, it's pretty ugly, and the trend is not shifting positive, at all. I haven't seen anything improving. While the dividend was around 173 million. Now, instead of paying 173 million, if they pay 85 million, their cash from operation is still only 76 million. It's not gonna even be enough to even cover the dividend. And let's assume it actually gets back to where it was in 2022, and they have something like paying 85 million and making 213. They're going to have maybe 120, 130 million left after paying down a dividend, but still not enough to pay down the debt. They have around 500 million in 2023, 446 million in 2024, 1.4 billion due in 2025, 2.8 billion due in 2026. So even the 50% dividend cut, and putting in the best case scenario for MPW, if the cash from operation gets back to 213, they're going to have some free cash flow left, which is great, but it's not going to be enough to start paying down the debt. But I'm very happy that the management is finally doing the right thing. They did cut the dividend, although I believe it should have been cut at least 70 to 80%, just my opinion. But they did do around the 50% dividend cut. They're trying to sell some assets to start buying back the debt, and this is where the value creation comes in. Because if you look at where MPW's debt is actually trading at, this is a chart I posted on Twitter, it's trading around 74 cents on the dollar. These kind of bonds, they were yielding around 3.8% to 4%. Now they're yielding 10.4%. So they can buy back those debt at much, much lower prices at a huge discount. This is what Michael Burry said about stocks that have a lot of debt in a high interest rate environment. Whenever the Fed starts raising rates, treasuries have a 5% interest rates, and anything against the treasuries is going to trade at a discount, which means companies like MPW can unlock massive shareholder value by actually paying back the debt, which is why I wish they actually made a bigger dividend cut, maybe 70 to 80%, would have created massive value to shareholders, but the company is sitting on a lot of valuable assets, is trying to sell some of those assets. This is very, very smart. The management is not the best in the world, but they're finally taking some action. This is very encouraging. I'm very happy to hear that, as I'm actually very interested in buying this company, not as a buy and hold forever, but more of a turnaround plan. But if you look at the debt, they have a lot of debt. It's concerning me, and it's locked in around the 4% interest rates, which means if they refinance them, their interest rate is going to be maybe 8 to 10%. It's going to kill the free cash flow. But if they get lucky and they just get through 2023, 2024, maybe in 2025 we have much lower interest rates, and then they can refinance them and push them after 2027. And this would pretty much save the company. It would save the shareholders. It would save everything. I mean, this would be like the best case scenario. We looked at the dividends health. I don't believe it's safe, in my opinion, even the recent one. If their cash from operations stays at only 76 million, the dividend is going to be more than 100% payout ratio. Even after the 50% dividend cut, I personally still don't believe it's safe. If I don't see any improvements in the cash from operations, I would not be surprised if they actually do another cut maybe next year or the year after. I'm not trying to predict this, but this is what the numbers are telling me. Even after the 50% dividend cut, the dividend is still not sustainable. But if you look at where the company is trading at, and this is where I see the potential, it's trading around half-time price to tangible book value per share. It's basically trading at 50 cents on the dollar, one of its lowest valuations since the 2008 to 2009 financial crisis, where it pretty much bottomed. But it doesn't mean it can't get worse, because in 2009 we got to around 0.35 times tangible book. I'm not predicting another 2008, but it could still get worse. But it's close to a historical generational kind of bottom for something like MPW. And if MPW just goes from trading at 50 cents at a dollar to $1.35 to 1.35, like it used to trade at on its mean, on its historical average, this would be more than 150, maybe closer to 200% on the upside, not including the dividend. So there's a lot of upside with the company. There's a lot of potential with the company. One of the highest risk, highest rewards in the stock market. Very high short interest. There could be a lot of short squeezes along the way, maybe from the retail investors or Reddit traders or whatever you want to call them. But I'm personally happy that the management cuts the dividend, but I still believe this dividend cut is not enough to deal with the debt unless they sell a lot more assets, and this is not bad, but I would have preferred a much larger dividend cut. Now, if next quarter or the quarter after I don't see an improvement from cash from operation, then I would still claim that even after a 50% dividend cut, I think it would still be a yield trap. It would still be unsustainable, and they might have to do another one in the future. But if in the next quarter or two I see improvements within cash from operation, I see reverting back on an upward trend momentum, I would be much more confident that maybe this was the low in MPW, this was the bottom in the stock, the bottom in cash from operations, the bottom in sentiment. It would change a lot of things. I mean, I would maybe personally enter a position in MPW if I see a upward momentum and trend, if the price is still trading at 50 cents on the dollar. So this is a very high risk, high reward kind of environment for MPW. I mean, there's a lot of things that could happen, a lot of things that could change. So, I mean, I don't recommend it to any kind of a conservative investor. You have other REITs like O Realty Income trading at 2020 kind of levels. You have triple net lease NNN yielding 6%. So there's a lot of other options for people that are more conservative. But if you're somewhat of a risk taker, I mean, there's a lot of bad sentiment with MPW. It can get worse if it doesn't get better. I will be monitoring the cash from operations on the next quarter to try to make some kind of a decision. But this was my video for today. No financial advice, of course. Thank you for watching the video. I hope you enjoyed it. If you did, please press the like button and maybe consider subscribing. So I hope to see you in another video.